Welcome to this video on the IRS hobby trap. We'll explore why your side hustle could cost you thousands and how you can protect yourself. Imagine receiving an IRS letter stating your side hustle is a hobby, not a business. They can tax all your revenue but eliminate all your deductions. The IRS uses IRC Section 183, the hobby loss rule, to enforce this and crack down on side hustlers. Classification matters. A business reports income and expenses on Schedule C, allowing net losses to offset other taxable income. A hobby reports 100% of gross income on Schedule 1, and you cannot deduct operating expenses to offset that income. This is the brutal tax trap. 100% of hobby income is fully taxable, and there is zero loss offset against W-2 income. Even with recent adjustments, deductions are capped at 90%, and losses still cannot offset wages. You are taxed on revenue while expenses are disallowed. The 3 out of 5 profit years is a myth. Hitting this mark only shifts the burden of proof to the IRS. If you miss it, you must prove profit intent. The IRS uses 9 specific factors to assess your intent, not just your bank balance. The IRS judges you based on your profit history and behavioral factors to reach a final classification. They look at how you behave, not just whether you turn to profit. Demonstrating professional intent across multiple factors is key. The 4 pillars of a real business include the manner of operation, like separate bank accounts. Expertise and study require documented research. Time and effort mean consistent work, and a history of success involves pivoting strategies when unprofitable. In practice, a hobby signal is using a personal checking account and working sporadically. A business signal is having a separate business account and actively tracking analytics with a monetization strategy. None of this requires genius, just professionalism. A real business uses a separate account and formal bookkeeping. A hobby mixes personal funds and uses shoebox receipts. A real business does research and consultations. A hobby has zero preparation. This chart highlights the differences across key factors. Step 1. Separate your money. Open a dedicated business checking account and credit card immediately. Never mix personal and business funds. This is one of the strongest signals of legitimate business intent. Step 2. Treat your books like a business. Use accounting software to track every dollar. Consistent bookkeeping shows a genuine profit motive, not just funding a personal hobby with tax write-offs. Step 3. Build a paper trail of intent. Keep a log of your working hours, business plans, and consultation notes. Documenting your decision-making shows the IRS you are thinking like an entrepreneur. Your audit-proof action plan is simple. Separate your money, track every dollar, and document your intent. Treat your hustle like a real business, and the IRS will find it incredibly difficult to call it a hobby. The stakes are real. The difference between a business and a hobby can mean thousands of dollars in back taxes and lost deductions. Stop acting like an amateur. Start documenting like a pro. Don't let the IRS win. You built something real. Protect it. Remember to separate your funds, track every dollar, and document your intent, hours, and plan.